Welcome back. It's May from Markets with May, and today we're going to go through First Republic. And it's kind of interesting because First Republic is clearly trading a little bit whack-a-mole in the aftermarket. I think I saw it at one point down 12. You guys can post in the stream if you're watching it and let me know what you're seeing it trading in the aftermarket. But I'm going to get to kind of the key points on this call, and then I'm going to go through the financials, and then we're going to just take questions from there. And I will go ahead and do the disclosures, past performance, not indicative of future returns. I am definitely in this position. I have essentially a strangle that's biased long. Let me say it that way. I am long this stock farther out, and I'm short this week as far as that goes because I was really worried about the volatility, but my net position on this is long. All right, let's get straight into it then. Thank you guys so much that are coming in late here to join me. But I want to kind of make sure that I give adequate background on First Republic, because First Republic is not just any regional bank. I want to be crystal clear on this. First Republic is the rich people's bank. That's what it is. It is the rich people's bank. And if it's unclear to you, I'm going to show that super clearly by using some of their past presentations and that demonstrate exactly what that business is. And as a result of it being the rich people's bank, here is how it looks like, in my opinion. Okay. First, if you're worried that let's say you're a client of First Republic, you live on the West or East Coast, and you're like, May, do I need to move my money or not? The answer is you do not need to move your money. The risk of a bank run is very low. They got the insured deposits adjusted such that it's now about 27% of all remaining deposits. And also, and this is really, really important, okay, they have $45 billion in cash against that deposit base. So it's cash and cash equivalents plus unused borrowing capacity, but essentially that unused borrowing capacity is the Fed, all right? So it is what it is. So if there is a bank run, if someone tries to attack them, they're going to need to plow through the 45 billion. And even then, all they're going to do is run into FDI insured deposits. So it's going to be a big fat nothing. So as far as like, should I be scared of First Republic having an issue? It's a lower, I'm not going to say zero because my goodness, this market is crazy, but definitely they're fairly fortified at this point between the Fed and all the other banks. They've done a lot to shore that up. Okay. So is it a short though, right? All right. So I'll get to the second question and then we'll go through the financials as I've mentioned. Okay. If you are long the stock, your issue is that someone does go ahead and take a run for it, and you get this bank run attempt, and it happens faster than they can find a buyer for it. Okay, which means then a lot of this analysis today is going to be about what is the breakup value of First Republic. So just wait for it. If you're short, though, your issue is that someone comes in and buys this at greater than 80% of book value, and that is actually a much higher probability than you think, only with a couple of caveats. So we're going to talk about that as well. All right. So let's just get through the headline numbers, which were ugly. All right. Total agreement, it was ugly. The key revenue was down 13%. EPS down with 32%. But the more important numbers for a bank are not revenue and EPS. So anyone focused on that is missing half the story, okay? Return on common equity was down significantly. It's usually about 12% for this bank, 10, 12%-ish, let's call it. It was 6.65%. And then book value is fantastic. Book value increased. And we'll talk about why in just a second. So it's kind of a mixed bag there, but I would argue that this particular way to read this is that if someone came in and bought it, it would be crazy pants good purchase if you just have lower leverage. They're leveraged about 8 times. That is a little bit on the high side, and that has to do with all this stuff that they're doing to kind of fortify and protect the bank against a run on a bank. Charge-offs were extraordinarily low, but they were up 6 basis points. But let me just show you why that would be stupid for anyone to care about charge-offs for this. And also why, like I said, this is the rich people's bank. All right. This isn't the common folks bank. This is the rich people's bank. And so this is what it is. Let me go back to these were your charge-offs. This is the charge-offs over the entire from 2000 to 2022. I know this is really little and some of it's covered. So let me just change the view here really quick so you can see this. This comes from, by the way, if you want to see the whole deck, this is their deck from their December quarter. And if you look at this, you will see very clearly that not only do they usually have zero charge-offs, okay, when they do, they even have negative charge-offs. Let me tell you what negative charge-offs are. Okay. Negative charge-offs are the opposite of a charge-off is a recovery rate. So it means that basically some rich guy couldn't pay his mortgage and they reclaimed the house and sold it for more. And the reason they can do that is because their average loan to value is really, really high. In other words, people only own maybe like 40 or 60%. They just couldn't make the payments because of whatever divorce, craziness happening throughout the years. And that's how you get a negative charge-off ratio. And that happens at this bank because, like I said, this the rich people's bank. Okay. Now let's talk about book value versus return on common equity. Now I prefer book value, and I'm going to tell you why. That's just shareholders' equity minus preferred equity divided by shares outstanding. So basically, the other way to do the same calculation, not sure why I pulled off this equation versus another, is you can take the total assets minus the liabilities. That gives you total equity, right? And so this book value to me is the cash value in the case, very important, in the case that you don't have write-offs, okay? We have almost no deterioration of the credit portfolio. So using book value as a metric is fine. Now, a lot of people will throw in my face every time I say that. Bear Stearns, Bear Stearns had great book value. What you talking about? Bear Stearns, Lehman Brothers. Let me tell you right now, there's a big difference between what happened in 2008 and right now. That difference is called credit losses. We don't have them. And of all the people that don't have them, rich people don't have them right now. Otherwise, you would have seen net charge-offs greater than 6 basis points, which is nothing. Okay. So book value is just fine as a metric, because book value is telling you what would be the loan basket that you'd be buying with almost no charge-offs if you came in to buy First Republic. And that right now you would be buying at 20% of book value. I mean, if it wasn't the case that the business model of private equity would be fundamentally not as fun for the people that own the private equity companies, the private equity would buy this at 20 cents on the dollar. It's ridiculous. Anyways, let's keep going so I can explain this. In contrast, return on common equity is going to be most impacted by one thing, and that's cost of capital. We're going to talk about that in just a second as we go through the income statement. All right, let's do it. This was the income statement. And I know that this is really painful for a lot of people to read. And Lord knows the banking group needs, the banking sector as a whole, if they want to be investable to others, needs to do a better job of explaining their financials. But you'll see on the release this top line number revenue, and you'll be like, I don't understand. When I go to look at the financials, I can't find it. Here is how you read the financials. You need the income or the revenue that comes in from loans made, meaning you gave me money, I invested that money, I got this thing called net interest income. Okay. So you need that revenue, and then you need the non-interest income, which is fee-based. So in other words, you're wealthy, you gave them money, they're charging you 1%, something like that, right? Or alternatively, you took out a loan with them, there's all those brokerage fees and everything like that. That's fee income. It's also called total non-interest income. Okay. That's fees. And then you can see all the other types of fees that they take: insurance fees, trust fees, stuff they sell. Okay. And then net interest income, usually, but everybody does a little bit different when they describe okay, I'm going to say that, but I don't really mean that. But essentially, a lot of times what'll get this confusing is there's a portion here, interest expense, that's the cost of borrow. So this net interest income, you can think of it, if you're trying to learn this area, you can think of it as cost of goods, removing cost of goods sold. So you can think of it as gross income, right? After cost of goods sold, because the cost is the borrow rate, the cost of the actual capital itself. Now, you will see that increased. Some of it is they're now given interest rates. That's what the deposit interest expense. Some of it is from borrowings. Okay. But as a result of this going from almost no cost, because rich people just gave them money and they did stuff with it, now because of all this other stuff that's happening, this is now the new rate of whatever their capital, which is a lot higher. And so net income down 33% is what you end up with, still in profit. All right, still profitable, but at a significantly lower rate. Okay. Is that a business model impairment? Not exactly, is what I'm going to say. Not exactly. The only reason and we're going to talk about that, but first I'll show you the balance sheet so that you can better understand why I'm saying not exactly. And I'll increase the size back up of this so you can see that. Okay. The reason I say not exactly, this is the balance sheet. Okay. Cash, huge increase in cash. And they did that for several reasons. They did that because they're afraid of run on bank. Okay. They did that because it was the prudent thing to do. Because if your cost of capital increases, it doesn't make as much sense to just arbitrarily invest in certain things. And they did. Okay. So that's the increase in cash right now. And also they just wanted to support whatever's going on. The other things on this balance sheet to look at, I'm going to go down here. This is the deposits. So 104 billion, hopefully you guys can see that, down from 162 last year, or 176. So, and then this right here was not there before. That's $105 billion. So essentially they supplemented the deposit-based capital with these short-term borrowings to the tune of about 60 billion. Now, the other kind of crazy pants thing to look at is they lost about $73 billion worth of deposits during the run on bank of Silicon Valley. That was in the press release, even stated more clearly, but this is where you find it. All right. Now, essentially, the way to think about that buffer is that until the amount of loans on the book matches the amount of cash that they have, they're going to continue to wind down that book thoughtfully. But because they got $30 billion from cash from other banks, and also the Fed has already told them they're going to support everything, and that's what these loans are, they don't have to do it aggressively and all at once. Okay. Now, additionally, this is very important. Additionally, the other thing to note is that they are about 8 times levered right now, which we're going to call it ever so slightly high, but they're well within their CET buffer. So this is not the wrong situation for them to be in. However, what that implies is that if a bigger bank came in and bought them such that they didn't need those loans, and they had actually the matching other side of the balance sheet, in other words, they had capital to give, then the return on common equity goes straight up. Right? Because the whole point is that you have a cost of capital change that's happening. Okay. And then given that these loans in the middle probably have a lower interest rate, so you had a principal mark, some of them will roll off. Then there's new loans that are happening because you can see that the total loan book did in fact grow on the quarter. Probably a lot of that had to do with before Silicon Valley Bank. And so looking at all of that, this is a very interesting acquisition target. And we're going to keep going here because you're probably like, well, why would anyone want to buy it? Here's the thing. These 3 ways to improve your return on equity. Number 1, get more deposits. Okay. Well, right now it's probably not ideal for them to do that kind of behavior per se, or it would be ideal, but they could just get a bunch more deposits. Number 2, they could decrease the size of the loan book itself. And that would immediately be used to pay down debt. Number 3, they get bought by someone with a better cost of capital, of which there are many. All right. Next thing. Why would somebody buy them? Because of this. All right. Like I said, they're the rich people's bank. This was from their slide deck in December. And while some of it's changed, not by much is the actual answer to the total percentage of what it is that they own. So they have about 4.5% market share of or 4.5%. Well, you can see it. They have 138 billion at that time of high net worth money, so to speak. So first in the urban market, 62% of all high net worth high net worth households. But, and this is really key. This is why when people ask me who would be a likely buyer, I'm always looking overseas, because this is pure play US wealth. So there are more than one European banks that have said, boy, I would be very excited to get more exposure to the US high net worth market. Like they've literally said those words, guys. So, the one in particular that has said specifically mouthed those words on the earnings call would be UBS. UBS said it when they purchased Credit Suisse. They said, we really wanted US, but we could work with Credit Suisse a little bit here. Now, do I think UBS going to buy First Republic? Probably would take some time. And the reason it takes some time is they got to swallow the anaconda. Like they're like an anaconda and they just swallowed an animal of equal size. They got to digest Credit Suisse first. Nonetheless, they were sitting there with 4 times leverage. The Swiss bank has already decided they're going to support them and all this other stuff going on. Now, I'm just naming that for example. There are lots of banks that would love to have that kind of exposure. So that kind of is what it is as far as that goes. But this is why. The other thing that I want to show, and I can see some of you guys are already putting questions in. Thank you for doing that. Did they lose high net worth assets? Yes, they did. Okay, and acknowledged, yes, they did lose some high net worth assets. 10% of the teams left, which represented 20%. They were covering 20% of the capital, but that doesn't mean 20% of the capital flies out, because you got to remember, what does that mean? The way that they're structured is that the teams that focus on high net worth people then sell the entirety of the bank's products to wealthy people. And you're not going to unwind all of that. For instance, if you have a home loan, you probably don't move the home loan, right? If you have, some sort of CD, what would be the point of going ahead and taking the loss on the CD by pulling out early? Now, some people did and they ended up taking some fees for early removal of the CDs, and thank you very much for your cash, one way or the other. But First Republic will retain some portion of those assets. And also, total assets grew by 6.7% on the quarter within the wealth management business. So that business is actually pretty good. And if you're already a bank overseas that would like more US exposure, so you're already structured as a bank holding company here in the US, First Republic's really interesting. I'm not going to lie. Now, do they need someone to buy them? No, they do not need someone to buy them. If you look at the numbers, they're fine. It's going to be ugly. It won't be beautiful, but if they just get through this period, they should be okay. And then if they're able to get any kind of growth on deposits, then it's fine. So there's that. But the better outcome for them would be just to get purchased. And that is all I have prepared. Hopefully that made sense. Now let me look through the comments and see what made absolutely no sense. Israel, you made it towards the end. You've got some EV comments. Okay. So Israel, just a shout out there. Deposits, strategy sessions. If there's something in particular you want to ask me on deposits, I'm not sure how to think about it. The deposits did look funky. That was pretty ugly. So I do agree. I'm not sure if that was the time that you commented. Yeah, I don't totally understand. Thank you, Juicy Got You Crazy. It's for the privates, the privies. I'm not sure what that means. I think you mean it's for the wealthy folk. That's true. And then some people, I think, are just saying hi on here. I have noticed that YouTube's been going a little wonky, and I do have a call in with them. They're claiming that the reason people aren't getting notifications is because they've turned off notifications somehow. So I told them that I would say that on my next show. If that's you, and you wanted my notifications, thank you for wanting my notifications. Just make sure that there's not something funny in your settings. And if you can remember to like, share, comment, or subscribe, that'd be amazing. That's actually all I have prepared. We'll see what happens tomorrow. Should be a very exciting market. Good luck, guys. Earnings season starts in a crazy way. So after that, we'll just do the best we can to put the information out as fast as possible. Take care.